Minute from go time here at the summit. If you could please take your seats, make your way back to your seats, and we will be ready for action in just moments. So please do take your seats. All right, ladies and gentlemen, we are back in action here at the summit hosted by the Hong Kong Monetary Authority. I'm going to ask all the good Canadians to take their seats. Hope you like the socks, Mr. Carney. You see that? You like that little Hudson Bay? Fantastic. And so you know that we are back, ladies and gentlemen. The doors are closed. The typhoon is outside. The brain power is inside this room. And we have a panel ready to go on side stage, ready for you. So this panel is going to be discussing sustainable finance. Now, whether it is environmental, social goals, or governance, ESG is very much in vogue these days. But our panel is going to be discussing how, and if it is possible, to make good on the promise of directing capital to virtue and profits. Fortunately, we have a spectacular moderator for this today. He was the former CEO Asia Pacific for JP Morgan before being elevated to their global head of private banking. Until all that happened, until early last year, he was appointed the Chief Executive Officer of the Hong Kong Exchanges and Clearings. Ladies and gentlemen, please welcome to moderate your panel, Mr. Nicholas Aguzin. Gucho, bienvenidos. We welcome to the panel Mr. Joseph Bay, the Co-Chief Executive of KKR. We welcome Jin Lee Kun, who is the President and the Chairman of the Board of Directors for the Asia Investment Infrastructure Bank. Thank you. We also welcome Anand Selva, who is the CEO of Private Banking and Wealth Management at Citigroup. And completing our panel, we welcome Hanneke Smits, who is the CEO for BNY Mellon Investment Management. Thank you very much. Gucho, the floor is yours. Take it away.
Thank you very much, and welcome everyone. Good morning. Great to see again so many faces in real person. It's a great event. Thank you, Eddie, for organizing, and all the HKMA team. We have a great panel with a diversity of backgrounds, people from the private sector, public sector, representing Asia, representing global, a lot of areas for a very important topic, and it's especially important for Hong Kong, being in the middle between China and the rest of the world, and in particular, a topic that is very dear to our heart at HKEX, because just last week we launched our climate exchange, which is a great initiative. We call it Core Climate, and it's going to be a great tool for making sure that we help in the transition. Now, today we're going to be talking about trends and how each of the different institutions here are tackling this sustainability challenge. And we're going to get right into it, and I'm going to start with Hanneke. Hanneke, I have a question for you around, is it possible to do good and to do well at the same time? And how should we be looking at the trade-off between social and private benefit? And let me add just one more point to this one. A lot of investors have been penalizing certain industries. In particular, oil and gas is one that's been discussed quite a bit. And there are many other industries, and we can think about agriculture and also electricity generation, whereby there are a lot of social benefits of really having those industries functioning, but they haven't been to the same level of scrutiny. So how are you looking at that, and how's your company looking at managing those balances?
Okay, thank you, Nicholas, and good morning. It's always a challenge to start with a two-part question of such great complexity. I also want to say thank you to the HKMA for hosting this. I actually started my career in Hong Kong in the late 80s and very much enjoy coming back and feeling its energy and connectivity to the mainland. I also thought it was very fitting, given the topic of this panel, that the last panel had a question on ESG and whether it's off the agenda. And I can assure you, as you can see on this panel, it is very much on the agenda and very much on the mind of investors, companies, governments, and alike. To the point, Nicholas, of whether you can do well by doing good, we very much believe you can. Responsible investment is really no longer a nice to have and is really increasingly embedded in all the investment decisions that we all face as investors and as shareholders. It's a very fast growing area of the market. I think you've all seen the numbers, and to some extent this is very much a shift in society from focusing on shareholder primacy to stakeholder responsibility. And ESG risks can really, speaking as an investor, can really no longer be overlooked when we value companies. They appropriately highlight the risks as well as opportunities and provide signals that drive valuation processes and can really materially impact intrinsic value. So I think it is actually absolutely possible to do well, to do financially well for investors by doing good at the same time, by focusing on companies that deliver sustainable business models. Now, to answer your question of how do we invest and where do we invest? Well, first of all, to address ESG, the world needs a lot of investment. We recently published a report that is showing that the world might need something along the lines of about $100 trillion to get to the goals of net zero by 2050. That's a lot of money, but in the context over a long period, we actually think it's achievable. Now, in order to do so, we must not shun the polluting sectors, and in particular, the sectors that need the investment the most are energy, utilities, and airlines. We believe it's very much going to be a combination of accounting for the value of stranded assets, which we estimate is going to be in the order of about $20 trillion. But we also, as an investor community, I think have a responsibility and duty to consider allocating capital to invest in those companies that need to align to net zero. So I think there's opportunities to invest. I think we must do it through engagement with companies and support them in their capital reallocations towards a greener world.
Thank you, Hanneke. And Joe, let me turn to you and to the private equity industry. And the PE industry obviously has been laser focused on returns, and KKR has been doing a lot in terms of sustainability. Particularly, you've launched a dedicated impact investing fund. And then, in addition to that, you've been very focused in promoting transparent reporting practices such as TCFD, aligned climate disclosures. So would love to understand a little more what's driving your decisions, how you're thinking about this, and the role that you play in the sustainability agenda.
Great. Well, thank you, Gucho. Let me first start by saying thank you to Eddie, your colleagues at HKMA, for having us here today. As also a former Hong Konger, I lived here for 10 years. It is really terrific to be back, to see the energy come back to the city, to see our colleagues, our friends, family, et cetera. So thank you for having us today. You know, this topic around sustainability and responsible investing, I don't think is at odds in any way with making great returns. I actually think it's foundational going forward to making great returns. Our job as private investors and also on the public side is to invest in companies and make them stronger, to build better businesses, more resilient businesses, to minimize the risk while you're owning these companies, and create something that's ultimately more valuable 5 years, 10 years down the road when you either take the company public or sell the business. And you can't do that in today's world unless you have a real focus and competency around ESG, around sustainability, and a focus on being really responsible owners of assets in the world. So for us, this journey is not a new phenomenon. We've been working on this for the past 15 years, really, in terms of trying to institutionalize these capabilities and practices. We partnered with the Environmental Defense Fund back in 2008, actually, to create a green portfolio program for KKR portfolio companies. We started publishing an annual sustainability report back in 2008, which we publish every year. In 2011, we started focusing on more the S of the ESG, which is broad-based ownership in the companies that we invest in, where we push stock ownership down to every single employee in these companies. That employee engagement is critical in a world like today where labor is in short supply, where people are worried about retention. That's proven to be an incredibly powerful tool to improve productivity, to align the workforce with management, and ultimately with shareholders to create more value. And what's exciting about today's world is when you have a focus on sustainability, there are incredible opportunities to invest today. This brown to green transition, which was just referenced, is going to create tremendous value. The opportunities for our impact fund, which are aligned with the United Nations SDG targets, our infrastructure business globally, that's investing in renewables. It's just an incredible time, actually, to have this focus for both great financial returns and to do the right thing.
Thank you, Joe. That's great. Anand, next question is for you, and tackling the E and the S in ESG. How do you think these two work together in terms of advancing the global sustainability goals, and what's your firm doing in terms of promoting sustainability?
Good morning, everybody, and thanks to HKMA for having us here. It's wonderful to be back in Hong Kong after 2-3 years, so good to be here. So the E and S absolutely go hand in hand, and our financing commitments at Citi are aligned with that approach. We look at it together. So we have a $1 trillion goal for, towards a $1 trillion goal in 2020 and 2021. We have financed and facilitated around $220 billion. It's a spectrum of activities. So if you look at the environmental activities will include clean technology, renewable energy, water conservation, sustainable transportation. And if you look at the social activities, it's around education, it's around healthcare, it's around affordable housing, food security. So it's been a wide spectrum of activities. And when I look at it in Asia here, Asia is a great example. We've had several firsts in Asia around green bonds, as well as in sustainability offerings with companies like LG Chem, BPI, Woolworths, to name a few. We also, last year, for our Asia clients, we raised over $40 billion in global and local capital markets to support their sustainability financing needs. So we've been working with our clients and helping them out. And in Hong Kong itself, we have one of the examples here will be our building, City Tower building. It is the largest on-site renewable energy system that we have. So we have been working with clients to helping their needs and helping them transition to net zero. At the same time, we've also been driving actions ourselves for the better of the environment and for long-term benefit of the communities. So a lot of activities, and it's a spectrum of activities, Nicholas.
Thank you very much, Anand. Jin, going back to AIIB, as a multilateral development bank, you play a key role in trying to bridge the gap between return expectations and also bearing some of the risks to help in this objective. So what are the tools that AIIB has to be able to deploy for this purpose? Have they been effective? And then also, I know you have a big war chest to do this, but the task ahead is really big, and there's a lot of capital needed in this transition. So what other parties can you enroll or enlist to try to help in this sustainability fund?
Thank you very much. It's very nice to be back in Hong Kong after an absence in international forums for a good 3 years. And it's so nice to see you in person. And I would like to say just a few words about Asian Infrastructure Investment Bank as a multilateral development bank. Probably people don't know very much about what it is all about. You know about the World Bank, ADB, EBRD, Our bank was created in the 21st century with the developing countries as majority shareholders. So this is a little bit different, even though we are patterned on the Bretton Woods institutions. But this is the first multilateral development bank with developing member countries as the majority, with our shareholders from all the continents except Antarctic. Now, this is a very important feature. You may ask me, if the developing countries are the majority shareholders, what is the incentive for European countries, developed countries to join? Because you made the rules, you play all the rules. Is there any rule for us to play? The answer is yes. We have very good check and balance, and European countries and also Canada, they have more than 25% of the votes. The major policies approved, or the election of the president, must have 2/3 of the members and more than 3/4 of the voting power. Which means even though China is the major shareholder, China will not simply call the shots. So this is the very good teamwork spirit. And just because of this nature, the bank focuses very much on development by very high standards. And we talk about ESG, we talk about green financing, sustainable development. And all this is deeply embedded, all these principles deeply embedded in our Articles of Agreement. So you talked about our war chest. Actually, it's quite negligible compared to the major financial institutions represented here. We work with BlackRock, JP Morgan, Morgan Stanley, HSBC, and all these institutions. I think our resources are very much limited. So what we do is try to leverage our resources to mobilize the private sector money for sustainable development. I think what is different today, we should never ever count on the public money for development. And I don't think it's right for development banks to knock on the door of the major shareholders asking for general capital increase every couple of years. That's not sustainable. So we focus very much on the cost effectiveness, and we look at the very essence of how to develop the infrastructure projects. We call it infrastructure for tomorrow. What does that mean? It's not infrastructure projects which are designed and implemented in a very traditional way. We incorporate climate change mitigation adaptation, and we have the framework to monitor the effects. For instance, all of the MDBs work out a climate change mitigation adaptation tracking methodology. So you look at our performance by all these public standards. Let me stop here.
Yeah. Thank you. And I'd just like to follow up on something you mentioned, which is the $1 trillion commitment that Citi made in terms of sustainable financing by 2030, I believe, correct? And I mean, clearly you have a very international operation. And I mean, how do you square trying to maintain consistency and a uniform standard with the practicality of having local operations and very local characteristic in each of the markets where you operate? Do you try to apply a consistent standard across the world, or do you take into account differences in each of the local markets where you operate?
Thank you, Nicholas. Great question. Similar to how we run our global businesses, we don't take a one-size-fits-all approach. We play to our strength, our global network, our global capabilities, and also our local expertise. So we have on-the-ground presence. So our on-the-ground presence, our relationships on the ground, our local capabilities are very important because that positions us uniquely to help our clients' individual needs. At the same time, we are very mindful that countries are at different stages of development, right? And social and energy needs vary by country. And sustainable development efforts are inherently local. I mean, issues like energy and food systems are pretty much hyper-local. So we lean into our local expertise to understand the local markets, the demographics, the local social and environmental challenges, and then combine with our global capabilities. So while towards our $1 trillion goal, we have global policies, global programs, but we marry them with our local on-the-ground presence. Now, as we build all of this, as we continue to all of us work together to reduce emissions, I think there are a few things we need to do. One is we need to find mechanisms where, from a funding perspective, as we fund decarbonization, the funding needs to be efficient and equitable. Today, most of the funding goes to investment-grade markets. The emerging markets are not getting the funding. And you cannot expect the emerging markets to be spending on decarbonization at the cost of their economic growth, because they have their own set of social challenges that they need to deal with. So it's our responsibility to help scale the funding, getting the funding for the developing economies, as well as looking at opportunities to fund new industries that support sustainable development. Now, all of this is doable. As we do all of this, I think one of the things that we need to work on is data. So we know that availability and the quality of ESG data has been an industry issue. Regulations are localized. You have disclosure requirements that vary. That leads to fragmentation of data, which leads to data complexity. So that's something we all have to collectively sort of solve for. And I guess there's an opportunity in Hong Kong for Hong Kong to take the lead, and being the leader in ESG in the region, and continue to lead in developing international standards, establishing regional sort of best practices and disclosures. Then you can sort of, we have to overcome the data complexities that we have and the fragmentation, and there's a great opportunity for Hong Kong to do that. I've also built out a carbon market here. So that's how we approach Nicholas. So it is not a one-size-fits-all. You got to be global and local altogether.
Okay, thank you. Jin, you're headquartered in Beijing. You invest across all of Asia. And by the nature of your institution and the projects that you invest, I mean, you're subject to a lot of scrutiny. In a world where, especially around sustainability, where we don't have standardization and there's increasing risks of like greenwashing, how do you manage those risks and that lack of standardization? And in particular, last year, you launched the Sustainable Development Bond Framework. So can you tell us a little bit more about that as well?
Well, thank you very much. The challenge of a multilateral development bank, particularly with China as the biggest shareholder, is formidable. And I know quite a lot of people put this bank under the microscope. If there's any defect, they are going to magnify it exponentially. So we are very careful. And reputation is very important. From the day one, we made it very much clear that this bank would go by international best practice. We would have very solid environmental social framework to follow. But we know reputation is something, or trust is something you have to earn. You cannot talk people into believing you. 7 years into operation, we grew from 57 founding members to 105. Why do these countries join us along the way? Because they believe we do what we declare. Okay, we mean what we say. So when it comes to the operations, for instance, everybody now is focused very much on climate change. As I said just now, climate change, mitigation, adaptation is very much important. And you cannot tell the people, we are doing wonderful things. By what kind of standards? That's why World Bank, ADB, this bank, they all work together to produce the climate change, mitigation, adaptation, tracking methodology. Likewise, ESG, environmental social framework, we have to process each and every project to make sure they will not violate international standards with regard to, for instance, environment. We are to improve environment, not to destroy environment. So everybody is watching us, and powerful CSOs, NGOs are following very closely everything we do. Now, talking about greenwashing, how can we make sure it's not greenwashing? For instance, we have this framework, Sustainable Development Framework would give you clear indicators. And we issue bonds, for instance. We can issue green bonds. And green bonds would be earmarked for instance, climate change mitigation projects. But our framework covers more. We work with the financial investors, institutional investors, making sure that this is a holistic approach to deal with the climate issues. So I think it's better than simply issue green bonds, which means everything we do, all the financial resources raised from the market would be for climate change mitigation. So I think there are a lot of things I have no time to elaborate, but by actual work on the ground, we can enhance people's confidence in this institution. I know it's very easy to lose confidence. When you lose confidence, they will never come back. Thank you very much.
Thank you. Hanneke, some people in the sustainable investment community point out that Asia is actually behind the other regions in terms of promoting sustainable investment practices. So can you tell us a little bit about your observation in terms of where client appetite, readiness between clients in Asia and the rest of the world is?
So sitting here in Asia, I would say the region is catching up relatively fast. It is behind certainly Europe for sure, and to some extent US, but we're seeing both from an investment required perspective as well as what we're seeing from our clients. We're seeing an increased desire and need for sustainable investment objectives to be integrated in the portfolios. And we also have started to see a framework being developed by the various regulators around the region. As previous speakers on this panel and the other panel have mentioned, clarity around data disclosures is really, really important in this context. So I think also this is to some extent, this catching up is also happening because this region is feeling very keenly the effect of climate change. I mean, we're sitting here, thank goodness the typhoon is sort of reduced, but the floods everywhere, increase in typhoons is bringing many of these issues to the fore, including of our investors and our clients. And having said that, sitting in emerging markets and in this part of the region, it actually needs about half of the investment that I mentioned earlier of this 100 trillion that is needed to get the world to net zero by 2050. And that is because the economies here are projected to grow faster, they're energy dependent, and so therefore it needs even more capital than we see in the developed markets needs to actually get to that greener future. I also think there's a great opportunity here from an investment perspective to leapfrog some of the carbon-intensive technology that we see is very much embedded in developed markets. And an analogy that comes to mind was how mobile phones leapfrogged the needs in Africa to actually lay down landlines which weren't in existence and saw an explosion in growth. And I think in the same way here, there's an opportunity to make some very interesting investments that are less carbon intensive and providing good opportunities in a sustainable chain. But with that, we must make sure we get better data and better disclosures, because in the short term, what we're seeing is there's a little bit of the knee-jerk reaction and risk that investors in the region divest rather than invest in the sectors that actually need it most.
Okay, thank you. Joe, you mentioned you lived for many years in Hong Kong. You know Asia very well. So how do you see the Asian landscape, and what are the challenges and opportunities in terms of sustainable investing? And you agree with Hanneke that Asia is catching up very quickly?
Yes, I definitely agree with that sentiment. You know, I think the context matters again. When you think about climate and carbon, the three biggest carbon emitters in the world are China, the United States, and India. For the world to really make progress around carbon and decarbonization, you need Asia to be a leading force in that, given the presence of China and India. The growing energy consumption, given the demographics, given the young populations, this is going to be both an enormous challenge for Asia, but also a tremendous opportunity for investment. And I think I'm more optimistic that regulators, governments, private sector will find a way to harmonize the data piece of this over time. The measurement of every company and reporting. I think that's something that will get done in a reasonably short period of time. I think the really hard work, though, is how do you actually not only measure, but what are the strategies to actually materially decarbonize and improve? That work is really, really difficult. As shareholders, as owners of businesses, I think that's where the focus needs to shift, is less about just getting the reporting right, which is foundational. We need to do that. But then it has to shift to what does it mean to be a responsible owner of a business? What are the right targets to be setting for management? And that's an infinitely harder, a problem to crack.
Okay, thank you very much. And I'll have now a last question for all the panelists. Hanneke, maybe I'll start with you. I mean, around the approach that we're taking to climate change today. Do we all believe that this is adequate, not just quantitatively also, but from a quality point of view? And should we look for other ways to tackle the problem?
So thinking a little bit through sort of the theme of this, of today, how we navigate uncertainty, I just want to first say the one thing is certain is that we must address the challenges that are upon us with respect to climate change. And combating climate change is clearly an enormous task, but it is still something that we believe is not insurmountable if we ensure that finance is being directed to the areas which most urgently need it. Now, the investor community cannot do it on its own, right? We're going to have to collaborate with government and policymakers to ensure that the right incentives and frameworks are put in place so that we can together achieve the goals that are needed by 2050.
Okay, thank you. And Anand?
Yeah, I mean, clearly sustainable finance is the future. There are obviously the things that we talked about is the interim that we need to work through. And financial institutions have a role to play in helping clients to transition to net zero. There are 2-3 things for me as comes up. One is obviously data. We talked a lot about data, so that's something that we all need to work on. And I think one of the things that I've found very encouraging listening to my Hong Kong colleagues here is that in Hong Kong, HKMA's Green and Sustainable Finance Center is working on developing talent and data. I think that is good. We need more of that. That is one. Secondly, obviously, I'm saying the obvious, we need enabling public policy and regulations. Because what we need is clarity and consistency, like we talked about in disclosures and in terms of data. So I think that's an important imperative there. The third is, Hanneke was saying, it's about partnerships. No single country or a single company is going to make this work. So it is all the stakeholders. It's a big teamwork of, it's the policymakers, the regulators, it's the FIs, it's the development banks, it's the civil societies, all need to come together to sort of drive this. At Citi, we are taking a long-term view on this. This is a 30-year event, right? And it's going to have significant upfront financing cost as we are sort of transitioning to clean energy and et cetera. So that's the way we look at it. I just thought a little bit of a, shifting gear a little bit for a second. I manage the wealth business. So when I speak to my wealth clients, it's very interesting. The wealth clients are more and more now focused on ESG as they're investing for themselves. And that has never happened before. So we see that happening. And we have a platform called Investing with Purpose. And our clients, we help our clients use that platform to make responsible investment decisions. And when this whole intergenerational wealth transfer is happening, which is estimated to be about $15 trillion by 2030. The next generation that's getting the wealth transfer is even more ESG conscious. So there is hope here. I mean, people, it's not only the institutions, even the individuals, as they're investing, they're looking at ESG and they're very focused on it.
Yeah.
Jin.
My view is that sustainable financing ultimately depends on the quality of the investment you make. I would say gone are the days when the private sector could come to certain investment, make quick wins and leave. I think time have changed. And even private sector investors will have to comply with quite a number of very tough standards. So how could we make sure that what we invest today would give us a long-term benefit, not individually, but collectively? I would say, for instance, we invest in infrastructure, which has a long gestation period associated with risks, particularly with regulatory and macroeconomic risks. Your due diligence of a project could be very good, but you didn't know about the macroeconomic or geopolitical storms. So individually, I think it will be even more difficult for the private investors to be assured of their success. That's why we need to work together. And also, I hope the investors who work with us will not expect this bank would close the gap of risk-adjusted returns. I don't think we can do that. But there's one big advantage of working with the multilateral institutions like our bank, IFC, or EBRD, because we have maintained a dialogue with the host country governments. Even though the projects we finance are private, we don't have guarantee, but we want to make sure that macroeconomic regulatory policies are in good place. If there's any change, they should be changed for the better. So I think we work together to create a very good environment for sustainable investment. The projects you finance are sustainable, and your financing will be sustainable. Thank you.
Thank you, Jin. Joe, your thoughts?
Listen, I do think there's a lot of progress being made. I think it's important to recognize, though, that whether it's companies, there are no two companies that are the same. They have different issues, different challenges, and one size does not fit all when we're talking about climate or ESG. And the same goes with the access to capital in markets like Asia, right? We have obviously China and India as two enormous economies where capital access is very different than, say, Southeast Asia. Smaller economies, less developed capital markets. So I do think there needs to be this recognition that where private capital certainly could add value is in some of those gaps. One of our largest investments through our infrastructure fund is in the Philippines, in First Gen. They produce almost 20% of all the electricity in the Philippines, and it's almost all renewable. It's geothermal, hydro, wind, and solar. But the Philippines is not a market that gets a lot of capital flows from international capital. Certainly from development banks and local banks, they'll get some capital, but there are real gaps in terms of just availability of funding. And I think that has to be a big part of the solution in this region.
Well, thank you very much to all my speakers. We're getting to the end of the time. We may have time for one question from the audience. So any questions for our panelists? Yes.
Thank you very much, Nicholas, and thank you very much to all members of the council, of the panel. My name is Tony Neo, and I sit on the board of ICBC and CITIC. And we completely agree with you that ESG is an organic part of the business environment, and it is there to create value for our shareholders. But I'd like to just drill down a little bit on the specifics. We have been seeing, in fact, in the past maybe 10 years, an increase in public and private participation, which is known as PPP, for the investment of infrastructure and so on. We see securitized projects, a securitized product coming out of these. The UN is very much involved in setting standards for PPP, I'm involved in one of those working parties, and I'd be very interested to know your views on how PPP could be effective in financing development, how in your portfolios you see PPP as being an effective method for creating value. Thank you.
Thank you. As a result of time limitations, maybe, Jin, you can take that one.
Tony, thank you very much. Nice to see you. It's a long time. I think this is a very important topic. So far, I would say PPP projects outcome seems to be mixed. And you cannot put down to any single root course if there's any problems with the PPP projects. The course for the public sector and the private sector work together. But there are also some very good projects in terms of PPP. I think, first of all, the government should provide facilities, but the government should not behave like a mother-in-law, you know? This is very much important. And the private sector should also know how to behave. I'll give you one example. Some very successful PPP projects in China. It's healthcare, old age care. The government provide low-cost land, and the private sector build the healthcare or old age nursing homes and this kind of thing. And they work it out very well, because taking care of the older people is a challenge for China. I think it will be increasingly difficult, but you cannot depend on the public money to take care of so many Chinese old people over 60 or 70. I'm young. I'm 36 years old, only the second round. So I don't need this kind of thing, help so far. But I do know there are lots of people who need it. So the projects I refer to, government provide low-cost land or some other facilities, private sector put money, and they work together on the market basis. I think that's the best approach. Thank you very much.
And thank you very much to all my panelists and to everyone. The conclusions of this is that this is an evolving space, a lot more to do, and we look forward to continuing the dialogue. Thank you very much.
Muchas gracias, Senor Aguzan. Thank you. If we could prevail upon our panelists to head to the center of the stage for a photo, that would be wonderful. Thank you. Thank you once again to our panel. I would like to remind everybody that there's a lot happening in Hong Kong this week. This is also Hong Kong FinTech Week is happening right now, and there's a bevy of events happening in the lead-up to the triumphant return of the Hong Kong Rugby Sevens. So I hope that you're going to be sticking around for the rest of the week and beyond to enjoy Hong Kong. Now, our next panel is going to be looking much farther.